So, hi guys, this is unit 2 of chapter 1. Okay, accounting concepts, principles, and conventions. This is a very important chapter, particularly whatever you have, whatever basics of accounting, bookkeeping, and everything we studied in unit 1. Here we are going step further, and this thing will be helpful to you in a long run. Okay, whatever is being taught here uh, in this particular chapter, up to CA final level and in professional life also, many things are very important. Okay, so let us continue. Accounting concepts, principles, and conventions. So what are we going to learn over here is grasp the basic accounting concept, principles, and conventions, and observe their implications while recording transactions and events. Identify the three fundamental accounting assumptions, that is going concern, consistency, and accrual. Understand the qualitative characteristics that will help to develop the skills in course of time to prepare financial statement. So unit overview is concept, principles, and conventions. So these are your concepts, or you can say principles or convention. That is entity concept, money measurement concept, periodicity concept, accrual concept, matching concept, going concern concept, cost concept, realization concept, dual aspect concept, conservatism, consistency, and materiality. Okay, so these are given in a very brief detailed manner. These are given in this particular chapter. Okay, so for topic 2.1 introduction, let us imagine a situation where you are a proprietor. Proprietor is the owner of the business, and you can take copies of your books of account to 5 different accountants. You ask them to prepare the financial statement on the basis of the above records and to calculate the profit of the business for the year. After few days, they are ready with the financial statements, and all the 5 accountants have calculated 5 different amount of profit, and that too with very wide variations among them. Guess in such a situation, what impact would it leave on you about accounting profession? So here what they have given me the scenario, imaginative scenarios is given. Okay, that you have your copies of your books of account, and you are going to an accountant and asking him to prepare your accounts and calculate your profit for the year, and everybody is giving you different amounts with wide variations. Okay, so guess in such a situation what impact it will leave, okay, on you about accounting profession. To avoid this, a generally accepted set of rules have been developed. These generally accepted set of rules provides unity of understanding and unity of approach in the practice of accounting, and also in better preparation and presentation of the financial statements. Okay, so accounting is a language of the business. Financial statements prepared by the accountant communicate financial information to the various stakeholders for decision-making purpose. Therefore, it is important that financial statements prepared by different organizations should be prepared on a uniform basis. Okay, so to make accounting a uniform, these are the principles or conventions. Okay, concept, principles, or convention, these are given to make it uniform. Everybody should be able to understand your accounts whenever, because businesses cannot be done with ourselves only, like, right? We business is usually done with the other parties, right? There are two parties involved in a transaction. So to understand a transaction, there should be some uniformity. If both are preparing on the same manner, then only you will get a correct picture. Okay, so also there should be a consistency over a period of time in preparation of the financial statement. In every accountant, if every accountant starts following in his own norms and notions for accounting of different items, then there will be an utter confusion. Okay, so own norms or notions cannot be formed over here. There are few guidelines given. We follow that, and basis that accounting is being done. Okay, to avoid confusion, to achieve uniformity, the accounting process is applied within the conceptual framework of generally accepted accounting principles. The term gaps is used to describe rules developed for the preparation of the financial statements and are called concepts, convention, postulates, principles, etc. These gaps are the backbone of the accounting information system, without which the whole system cannot even stand erectly. These principles are the ground rules which define the parameters and constraints within which accounting reports are generated. Accounting principles are basic norms and assumptions on which the whole accounting system has been developed and established. Accountants also adhere to various accounting standards issued by the regulatory authority for the standardization of accounting policies to be followed under specific circumstances. These conceptual frameworks, gaps, and accounting standards are considered as the theory base of accounting. Globally, for achieving the standardization, countries use the framework under International Financial Reporting Standards, that is IFRS. However, countries may apply their respective gaps and related conceptual framework. For example, in India, companies are required to use account AS, that is accounting standards, or IND AS, Indian Accounting Standard framework, as applicable. These are further details. These are very vast. Accounting standards and Indian accounting standards. Okay, at final level, Indian accounting standards are part of the curriculum. Okay, and at interlevel also, I think accounting standard and Indian accounting standards, Indian accounting standards are part of the curriculum. Okay, so right now you don't need to worry about what is GAAP or what is IFRS or what is accounting standard or what is in Indian in Indians. Okay, this will be you will study in an extensive manner at a further stage. So this is whatever you are learning, this is the base right now. And as a student, when I was a student, this after studying accounting, this was the one of the very best or favorite chapter of mine as a student. Okay, I like all these concepts and everything, and which has helped me to understand accounts in a very nice and extensive manner. Okay, yeah. So let us continue. 2.2 Accounting concepts. Accounting concepts defines the assumptions on the basis of which financial statements of a business entity are prepared. Certain concepts are perceived, assumed, and accepted in accounting to provide a unifying structure and internal logic to accounting process. The word concept means idea or notion, which has universal application. Financial transactions are interpreted in the light of the concepts which govern accounting methods. Concepts are those basic assumptions and conditions which form the basis upon which the accounting has been laid. Unlike physical science, accounting concepts are only results of broad consensus. So, unlike physical science, okay. So here, there is a logic to the accounting process. Okay, and there has to be consensus. Okay, the accounting concepts lay the foundation on the basis of which accounting principles are formulated. So the accounting principles are a body of doctrine commonly associated with the theory and procedure of accounting, serve as an explanation of current practices and as a guide for selection of conventions or procedures where alternatives exist. Accounting principles must satisfy the following conditions. They should be based on real assumptions. They must be simple, understandable, and explanatory. They must be followed consistently. They should be able to reflect future predictions. They should be informational or for the users. Next, accounting conventions. Accounting conventions emerge out of accounting practices commonly known as accounting principles adopted by various organizations over a period of time. These conventions are derived by usage and practice. The accounting bodies of the world may change any of the convention to improve the quality of accounting information. Accounting convention need not have universal application. In the study material, the term accounting concepts, accounting principles, and accounting conventions have been used interchangeably to mean those basic points of agreement on which financial accounting theory and practices are founded. So whatever we are learning over here, whatever we will understand over here, it will be used throughout your accounting cycle, accounting profession. Okay, in Indies or Indian accounting standards or GAAP or IFRS, everything is based on these principles. Okay, concepts and principles. Okay, so without this, it is not possible to uh, understand your accounting standard or in days. Okay, so concept, principles and conventions, an overview. So number one is entity concepts. So entity concept, if I give you the brief of the entity concept, it means that owner owner and the business both are separate, both are distinct person, both are separate. Whenever you are writing accounts, okay, you are writing accounts for the business and not for the owner. Okay, that is your entity concepts. So let us read what is given here. Entity concept. Entity concept states that business enterprise is a separate identity apart from its owner. Accountant should treat a business as distinct from its owner. Business transactions are recorded in the business books of account and owner's transaction in his personal books of account. The practice of distinguishing the affairs of the business from the personal affair of the owner originated only in the early days of the double entry bookkeeping. This concept helps in keeping business affairs free from the influence of the personal affairs of the owner. The basic concept is applied to all the organizations, whether sole proprietorship or partnership or corporate entities. Okay. So whatever is the form of the organization, this sole proprietorship, single person is owning the business, or there is a partnership, more than two people are there, two or more people are there, or there is a corporate entity. Okay, everywhere these basic concepts are applied. Next, entity concept keeps the business separate from its owner. In a way, the entity concept helps to ascertain how much amount of money is due to the owner in form of his capital and share of profit earned. It also helps to perform accounting from the point of view of the business and not that of the owner. For example, if a person runs a business and pays money from his own pocket for his son's school fee, it will not constitute a transaction in the books of the business. However, if a person withdraws money from the business to pay for his son's school fee, it will constitute a transaction to be recorded in the books of the business as amount withdrawn by the owner. So here, when school fees are paid, it is not a business transaction; it is a personal expenses. Okay, so it will be separate. It will not be recorded in the books of account as a school fee, but it will be recorded as a drawings of the owner. Okay, withdrawn by the owner. Entity concept means that enterprise is liable to the owner for capital investment made by the owner. Since the owner invested capital, which is also called risk capital, he has claim on the profit of the enterprise. So what is meant by risk capital means anybody starts a business. So starting a business, you need certain amount money. Okay, so the person is risking his capital. Person is risking his capital. Okay, so your owner has invested a particular amount, it is risk capital, and he has a claim on the profit. He has a claim on the profit means whatever is being earned by the business, it is his own. Okay, whoever are the owner of the business, they claim the profit. Okay, a portion of the profit which is apportioned to the owner and is immediately payable becomes current liability in case of corporate entities. Okay, so a portion uh, uh, a portion of the profit which is portion of the profit which is apportioned to the owner means whatever is from total profit, a part of the profit which is apportioned to the owner is immediately payable becomes current liability in case of the corporate entity. Current liability means whatever is payable. Okay, business organization is to be paid, whatever amount is paid to be paid by the business. Okay, so whatever profit is distributed, simple example is dividend. Okay, whatever dividend, when a person buys a company's share and the company is paying dividend, so the dividend is the becomes current liability in case of a corporate entities. Okay, example, Mr. X started business investing rupees 7 lakhs, with which he purchased machinery for rupees 5 lakhs and maintained the balance in hand. The financial position of the financial position will be as follows. Capital 7 lakh, machinery 5 lakh, cash 2 lakhs. Okay, this means that the enterprise owes to Mr. X rupees 7 lakhs. So Mr. X has invested total 7 lakhs. So whenever business is shut down, business is closed down, so this 7 lakh is to be repaid to the Mr. X. Okay, and with 7 lakh, now business is a separate entity. So what business is doing with that 7 lakh rupees? They are buying 5 lakh rupees of machinery and 2 lakh rupees as a cash. They have kept it with themselves. Okay, business has kept with him. Okay, Now, if Mr. X spends rupees 5,000 to meet his family expenses from the business fund, then it should not be taken as business expenses and would be charged to his capital account. That is, investment would be reduced by 5,000. Following the entity concept, the revised financial positions are as follows. So, whatever money 7 lakh rupees was invested by Mr. X, okay, out of which now he is withdrawing 5 lakh rupees for his personal expenses. Okay, so now capital of the owner will become from 7 lakh to 6 lakh 95,000. Machinery will be same value 5 lakh, and cash will be reduced by 5,000. It is from 2 lakh 5,000 is withdrawn, so 1 lakh 95,000 is left over. So here again entity concept is about there is a one particular person called owner, and there is a second person called entity, business organization. Okay, so both are separate. Okay, so owner's personal expenditure are not recorded in books of account. Okay, and whatever owner is bringing the money in the business, which is termed as capital, is the liability on the business to be repaid to the owner. Okay, next, money measurement concept. As per this concept, only those transactions which can be measured in terms of money are recorded. Since money is the medium of exchange and the standard of economic value, this concept requires that those transactions alone that are capable of being measured in terms of money be only to be recorded in the books of account. Transactions, even if they affect the results of the business materially, are not recorded if they are not convertible in monetary terms. For example, a business owning a factory on a piece of 1 acre of land with an office building with 2 floors having 20 computers and 10 units of machine cannot show these items under different measurement unit. These items need to be expressed in monetary terms. The factory price might be 50 crore, cost of land might be 30 crore, building with a cost of rupees 15 crore, computer at a cost of 10 lakhs, and machine with a cost of rupees 10 crore needs to be recorded. So here, whenever in business we have to convert anything non-monetary to monetary. Okay, non-monetary to monetary, or everything will be in terms of monetary only, but at times if it is not in monetary terms, then we have to convert that non-monetary item into monetary, and the monetary values are recorded. However, the concept has its own limitations. The transaction event that cannot be expressed in terms of money are not recorded in the business books. For example, employees of the organization are no doubt the asset of the organization, but their measurement in monetary terms is not possible, therefore not included in books of accounts of the organizations. Okay, so here they have given you an example that employees are the assets of the business, because without employee, business cannot run smoothly. Okay, so here you have employees, okay, and employees are an asset to the business, but they are not recorded in books of accounts. Okay, measuring unit of money is taken as the currency of the ruling country. That is, the ruling currency of a country provides a common denomination for the value of material object. Say for example, in India, INR, Indian National Rupee, is the currency. Okay, you go to any other country, they have their respective currency, and with basis that they will record their books of, they will prepare their books of account on that in that currency value. Okay, next. It may be mentioned that when transactions occurs across the boundary of a country, one may see many currencies. Suppose a businessman sells goods worth 50 lakh at home, and he also sells worth of 1 lakh euro in United States. What is his total sales? 50 lakhs plus 1 lakh euro. Okay, so now if the person is doing export, okay, and he is receiving in foreign currency, that is euro. Over here example given is euro of 1 lakh. So in India also they are selling goods of 50 lakhs, and in euro also they are selling 1 lakh euro of goods. Okay, these are not amenable to even arithmetic treatment, so transactions are to be recorded at a uniform monetary unit, that is in one currency. Suppose 1 euro is equal to 71 rupees. So now see, you cannot prepare books of account with multiple currencies at the same time. So what you need to do is you need to convert the foreign currency into the domestic currency. Okay, so here 1 euro is equal to 71 rupees. So 1 lakh euro is equal to 71 lakh rupees. So total sales will be 50 lakh local sales plus 71 lakhs of export sales, equals to 121 lakh sales. Okay, money measurement concept imparts the essential flexibility for measurement and interpretation of accounting data. This concept ignores that money is an elastic yardstick for measurement, as it is based on the implicit assumption that purchasing power of the money is not of sufficient importance as to require adjustment. For example, a unit of land purchased 10 years ago for rupees 40 crore and a similar unit of land purchased now for rupees 90 crore will still be shown at the respective value, that is total of 140 crore, though in real world the true value of the unit together might be 180 crore. Accordingly, accounting does not give a true and fair view of the affairs of the business. So here what is happening, before 10 years we have purchased a land which was 40 crore rupees. Right now we are purchasing similar size of the land in the similar locality, but we are supposed to pay 90 crore. So total value paid by the business is 40 crore plus 90 crore is 130 crore, but actual value of that 40 crore land which was purchased 10 years ago is now 90 crore rupees, but we are not adjusting our books of accounts here. Okay, value will be shown as 130 crore only and not 180 crores. Okay, next, as mentioned earlier, many material transactions and events are not recorded in the books of account just because they cannot be measured in monetary terms. Yet it is used for accounting purposes because it is not possible to adopt a better measurement scale. Entity and money measurement are viewed as the basic concepts on which other procedural concepts hinge. Number C, periodicity concept. So accounting is recorded in one particular period. Whatever transactions are recorded, collectively we measure it in terms of profit or loss, so periodicity concept is very important. So the transactions or events are occurring in which period, and basis the period they are recorded and our financial results is arrived. Okay, so see, periodicity concept. This is also called the concept of definite accounting period. As per going concern, concepts as indefinite life of the current entity is assumed. For a business entity, it causes inconvenience to measure performance achieved by the entity in the ordinary course of business. If a textile mill lasts for 100 years, it is not desirable to measure its performance as well as financial position only at the end of its life. So every business has a life cycle. So if a textile industry lasts for 100 years, textile mill, so it is not correct to measure total transaction at the end of the 100 years. Okay, every year we are supposed to measure the transactions. Okay, so a small but workable fraction of time is chosen out of infinite life cycle of the business entity for measuring performance and looking at the financial position. Generally, 1 year period is taken up for performance measurement and appraisal of financial position. However, it may also be 6 months or 9 months or 15 months. According to these concepts, accounts should be prepared after every period and not at the end of the life of the entity. Usually, this period is 1 calendar year. We generally follow from 1st April of a year to 31st March of the immediately following year. So here, what we are doing is, accounting can be for 6 months, 9 months or 15 months, but usually we are following 1 year period which starts from 1st April and ends on 31st of March of the immediately following year. So 12 months period is there, it starts on April and ends in March. Thus, for the performance appraisal, it is not necessary to look into the revenue and expenses of an unduly long term. This concept makes the accounting system workable and the term accrual meaningful. If one thinks of indefinite time frame, nothing will accrue. There cannot be unpaid expenses and non-receipt of revenue. Accrued expenses or accrued revenue is only with reference to a finite time frame, which is called accounting period. Thus, the periodicity concept facilitates in number 1, comparing of the financial statement of different period, that is 12 month, 12 month, 12 month. We can compare our business each year, year 1, year 2, year 3. We can compare uniform and consistent accounting treatment for ascertaining the profit and assets of the business. So whatever profit we are making in first year, second year, third year, whatever business we have in the first year, second year, and third year are compared. And number 3, matching period revenues with expenses for getting correct results of the business operation. So we are periodically we are matching the expenses. Okay, so last year we have paid so and so amount of rent. First year rent was X amount, second year's rent was X plus 1, third year rent was X plus 2. So whatever rent increases there, we can compare it. Okay, and basis the if rent is increasing, then business should also increase. Okay, so we have this thing, what you call periodicity concept. The first was your entity concept, second was money measurement, and third is your periodicity concept. Okay, next is accrual concepts. Accrual means in which particular period transaction has happened, in which particular period transaction has happened. If money is not paid or not received, money is not paid or not received. Okay, so whenever goods are purchased on credit or goods are sold on credit, or transaction happens where money is not involved currently, but transaction event or transaction in event has occurred. Okay, so we have to record that particular transaction, though money will be received in future period or money will be paid in future period. So okay, that is accrual concept. Say for example, if we are selling goods, so from April to March we are selling the goods, but in the month of March or in any period between the year, we have sold certain goods on credit. The money is not received, okay, but still we will record the sales. We will record the sales in the books of account, okay, and money will be termed, the money which is not received, it will become receivables. It will become receivables. These receivables are called as trade receivables or called as debtors. Okay, so one side money is not came, but sales has happened. Okay, let us read it. Under accrual concept, the effect of transactions and other events are recognized on mercantile basis, that is when they occur, and not as cash or a cash equivalent is received or paid, and they are recorded in accounting records and reported in the financial statements of the period to which they relate. Financial statements prepared on the accrual basis informs users not only of past events involving the payment and receipt of cash, but also of obligations to pay cash in the future and of resources that represent cash to be received in future. To understand accrual assumptions, knowledge of revenues and expenses is required. Revenue is the gross inflow of cash, receivables and other considerations arising in the course of the ordinary activity of an enterprise from sale of goods, from rendering services, and from the use by others of enterprise resources, yielding interest, royalties, and dividends. For example, number one, Mr. X started a cloth merchandising. He invested rupees 50,000, bought merchandise worth rupees 50,000. He sold such merchandise for rupees 60,000. Customer paid him rupees 50,000 cash and assured him to pay rupees 10,000 shortly. So his revenue is 60,000. It arose in the ordinary course of cloth business. Mr. X received 50,000 in cash and rupees 10,000 by way of receivables. Take another example. Number 2. An electricity supply undertaking supplies electricity spending rupees 16 lakh for fuel and wages and collects electricity bill in 1 month rupees 20 lakhs by way of electricity charges. This is also revenue which arose from rendering services. Okay, so in the first example, we have invested 50,000 rupees. Of 50,000, from 50,000 we purchased merchandise. Merchandise means stock. Okay, we purchased the stock and that stock is sold for rupees 60,000 rupees. Okay, and after that 60,000 rupees, 50,000 is received in cash and 10,000 will be received shortly. But still revenue the sales of the business is 60,000. Okay, so we record 60,000 in the books of account, like for 50,000 received in cash and 10,000 is a receivable. In second example, electricity supply company, they have spent 16 lakh rupees on fuels and wages etc., and they are recovering 20 lakh rupees as a charges. Okay, so your 20 lakh is the revenue. Third point, Mr. A invested rupees 1 lakh in the business. He purchased a machine paying rupees 1 lakh. He rented it for rupees 20,000 to Mr. B. So to Mr. B, rupees 20,000. So rupees 20,000 revenue of Mr. A. It arose from the use of the PG Enterprise resources. Where is this PG Enterprise mentioned? Okay, this is taken from somewhere else. They are mentioning the PG Enterprise resource details over here. So what it means is like 1 lakh rupees invested, they purchased a machine, and machine again after purchasing it is rented to somebody, and 20,000 revenue is coming. Okay, next, expenses is a cost relating to the operations of an accounting period or to the revenue earned during the period or the benefit of which do not extend beyond that period. In the first example, Mr. X spends rupees 50,000 to buy the merchandise. It is the expense of generating revenue of rupees 60,000. In the second instance, rupees 60 lakhs are the expenses. Also, whenever any asset is used, it has a finite life. Finite life means there is an end of a life of a particular assets. Okay, it has finite life to generate benefits. Suppose machine purchased by Mr. A in the third example will last for 10 years only. Then 10,000 is the expense every year relating to the cost of the machinery. So 1 lakh was the cost. 10 years it will useful life, so 10,000 rupees each year it is an expense. Okay, this expense is termed as depreciation. Those who are from commerce background are aware about what is depreciation. Those who are not from commerce background, don't worry, you will have a detailed chapter on the same in your further sessions. Next, accruals means recognition of revenue and cost as they are earned or incurred and not as money is received or paid. The accrual concept relates to measurement of income, identifying assets and liabilities. Example, Mr. JD buys clothing of rupees 50,000, paying cash 20,000 and sells at rupees 60,000, of which customer paid only 50,000. So what is happening? He is buying 50,000 rupees of clothing by paying only 20,000. So 30,000 is yet to be paid. Now he is selling the goods at 60,000 rupees and customer has paid 50,000 rupees. Okay, so 10,000 rupees is to be received, and while purchasing 30,000 is to be paid. Okay, so his revenue is 60,000, not 50,000 cash received. Expense, that is cost incurred for the revenue, is 50,000, not 20,000 cash paid. So accrual concept basis profit is 10,000, revenue minus expenses. So he's supposed to receive his total received amount or receivable amount will be 60,000 and total payable will be 50,000. So 10,000 is the profit of the business. As per accrual concept, revenue minus expense is equal to profit. Accrual concept provides the foundation on which the structure of the present day accounting has been developed. Alternative as per cash basis. In cash basis, whatever cash is received and whatever cash is paid is only recorded, but in accrual basis, whatever is receivable or what is payable are recorded. Okay, so cash received in ordinary course of business minus cash paid in ordinary course of business is equal to profit. Usually in service sector, people follow cash basis. Say for example, there is a doctor, there is an accountant, there is a legal profession. Okay, so whatever money is received, that is only recorded. Whatever is yet to be received is not recorded in books of account. As and when it comes, it will be recorded in that particular period. So why this is important? In accrual basis and periodicity concept, matching concept, here we are supposed to period basis the period we are supposed to record the transaction, right? So in accrual we are recording the transaction to derive a particular profit. So in cash basis, whatever is received and whatever is paid is considered, but in accrual basis, we have not received money but still transaction has occurred, we record it. Next, timing of the revenue and expenses booking could be different from cash received or paid. When cash received before revenue is booked, a liability is created when cash is received in advance. So here, if the money is received in advance, okay, so it is a liability for the business. Liability means to be payable in terms of cash or in terms of goods. Okay, when money is received for a particular product or particular service in advance, so we have to provide a product or a service to the person who has given us the advance. Next, when cash received after revenue is booked, an asset called trade receivable is created. Okay. Next, when cash paid before expenses booked, creates an assets called trade advance when cash is paid in advance. So these are like assets, trade receivable, trade advance. Words are for the non-commerce students. This thing might go beyond your limit. Sorry, but hang on tight. Okay, gradually you will understand this. Number 4, when cash paid after expenses booked creates a liability called payable or trade payable or outstanding liability. Okay, so this was your accrual concepts. Okay, I am stopping the video over here. For the topic we will cover in next video. Okay, from matching concept we will cover in the next video.